Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 1. This is section B1. This is an application topic. Use forecasting and projection techniques to model financial results, including revenue growth, cost and expense characteristics, and profitability. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to a lot of great stuff, including the Pro course, which is basically a much more in-depth version of the webinar where Nate goes really in-depth on exactly what you're supposed to be doing to pass the exam. And they also get access to the full versions of these YouTube videos. So in today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members get access to the full 10-question video when we post it in the forum. So if you like this and you like the other videos or even the videos for the other sections, make sure you check out becoming a SuperfastCPA Pro member to get access to the full versions. Now with that, let's dive straight into the questions for this video. All right, here we are at question 1. Let's just dive straight in. One thing I always like to point out is as you are going through questions, and especially when you're on the exam or when you're at the exam on test day, you want to read the last sentence of the question first. This is a very good strategy or habit to be in because frequently, if you read the last sentence first, that will give you context for what the question is even about, what it's even asking you to do. So you read that so that you can know what you're supposed to be looking for throughout the rest of the question. So let's do that here, and we'll do that with the other questions too. Based on this information, what is the break-even point in both units and sales dollars? Okay, let's go up to the top. A company sells a single product for $50 per unit. Variable costs are $30 per unit, and total fixed costs are $120,000. Based on this information, what is the break-even point in both units and sales dollars? Okay, so if you have any idea how to calculate break-even points, then you might have an idea of how to do this. But if not, that's okay. We are going to use this question to learn how to do this. And again, this is a piece of forecasting or projections is to figure out at what point you need to get to break even, to not be losing money, but rather be starting to make money. So if you don't know how to do this, that's okay. If you want to give it a try, go ahead and pause the video. And when you're ready, come back. We'll look at the answer together. All right, here we are at the answer C, 6,000 units and $300,000 in sales. So it would take 6,000 units to break even, and that is $300,000 in sales. So let's go through this. To find the break-even point, we need to determine how many units must be sold and how much revenue must be earned, and that those two are tied together to cover all fixed and variable costs, resulting in zero profit or loss. So again, this is the point where you're not losing money and you're not making money yet, but again, the whole point is you're not losing money anymore. First, calculate the contribution margin per unit, which is the amount from each sale that contributes toward covering fixed costs. So you take the sales price per unit and you subtract the variable cost per unit, and that gives you $20 per unit. That is the contribution margin, how much it's actually contributing to profit. Then you calculate the break-even point in units using the formula, fixed costs divided by the contribution margin per unit. So $120,000 divided by the $20 of contribution margin, and that gives you 6,000 units. That is the break-even point in units. That's how many units you would have to sell to break even. And a lot of times if you see questions on the CPA exam, it might only ask you to do the break-even units, or it might only ask you to do the break-even sales. But this question is kind of doing both of them, again, to show you that they're pretty much connected. To find the break-even point in sales dollars, multiply the break-even units by the selling price. So 6,000 multiplied by $50 per unit, and that gives you $300,000. So again, the whole point of this is projecting or forecasting how much you need to sell to get to the break-even point so that you know at what point you're not going to be losing money anymore and you are going to start making profit after that point. So this is something important you need to know. In fact, break-even stuff seems to be one of the most important parts of forecasting and projections from what I've seen. So make sure you understand this, and we're going to talk a little bit more about it in different ways throughout the video, but let's go ahead and go to question 2. All right, here we are at question 2. What is the required sales volume? Let's go up to the top. Davis Co. sells a product for $100 per unit. Variable costs are $60 per unit, and total fixed costs are $80,000 per year. Management wants to project how many units must be sold to generate a target profit of $20,000 for the year. So again, what is the required sales volume? Now, based on what we learned in the first question, you could maybe start figuring out how to do this one. And if you already know how to do it, that's great. But if not, that's okay. We are going to use the explanation to learn how to do this. So let's go ahead and dive into the explanation right now. All right, here we are at the answer D, 2,500 units. That is the amount of units that they would have to sell to be able to generate a $20,000 profit. So let's go through this. To calculate the number of units required to meet a target profit, so we're not talking about the break-even point this time, we're talking about making $20,000 in profit, we have to use the following formula. First, we have to take the target profit and add the fixed costs, and then we can divide it by the contribution margin per unit. And the reason we have the target profit plus the fixed costs is if it was just fixed costs, that would be the break-even point. But we also want to add the extra $20,000 on top of the fixed costs, so that's why we do that. The contribution margin per unit is the $100 sales price less the $60 of variable costs per unit, and that gives you $40 of contribution margin per unit. To cover $80,000 in fixed expenses and achieve $20,000 in profit, you have to cover $100,000 total. So $100,000 divided by $40 per unit is 2,500 units. That's how many units you have to make to not only break even, but also make $20,000 in profit. This method is a key forecasting technique used in budgeting and planning. It allows management to model how sales volume relates to profitability by incorporating both fixed costs and variable margins into the projection. So again, learning a little bit more about projections and forecasts in this question. Now let's go to the next question. All right, here we are at question 3. Based on this projection, what is the expected operating income or loss? Okay, let's go to the top. Langley Co. sells a product for $75 per unit. Variable costs are $45 per unit, and total fixed costs are $90,000. Management is projecting sales of 3,500 units for the upcoming year. Based on this projection, what is the expected operating income or loss? So this is somewhat similar to question 2, but coming at it from a different angle. What is the operating income or loss that they're expecting based on this projection? Now, pause the video, take what we've learned from the other 2 questions, and I feel like you could probably figure this out. When you're ready, come back, we'll look at the answer together. All right, here we are at the answer. A, $15,000 operating income. So that's the projected amount of operating income for the next year. So let's go through this. To forecast operating income, start by calculating the contribution margin per unit. This is the portion of each sale that contributes to covering fixed costs and generating profit. The contribution margin per unit is $75 less the $45 of variable costs, and that gives you $30 of, again, contribution margin per unit. Next, multiply the contribution margin by the projected number of units to get total contribution margin. So 3,500 units multiplied by the $30 of contribution margin per unit, and that gives you $105,000 of contribution margin. This represents the amount available to cover fixed costs and produce profit. Subtract the fixed costs from the total contribution margin, so $105,000 less the $90,000 of fixed costs means that there's going to be still $15,000, and that's going to mean that since the contribution margin exceeded the fixed costs by $15,000, that is an operating income of $15,000. This kind of projection helps management determine whether expected sales volumes will lead to profit or loss, which is essential for budgeting, planning, and decision making. All right, so again, based on what we've learned in the other ones, this one probably wasn't too bad if you kind of thought about it in the way that we've been thinking about the other 2. Now let's go to the next question. All right, here we are at question 4. What price per unit should Merit charge? Okay, let's go to the top. Merit Co. is launching a new product and expects the following costs per unit. Direct materials of $12, direct labor of $8, and variable overhead of $10. Total fixed costs are expected to be $60,000. The company plans to sell 5,000 units and wants to set a sales price that yields a 40% profit margin based on the sales price. What price per unit should they charge? Okay, so again, based on what we've learned so far, you probably could kind of figure your way out through this. It's a little bit different than what we've seen, but again, just try to think of how could we take these numbers and get a 40% profit margin? What price would we need to do that? So pause the video, think about this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is D, $50. So let's go through this. First, you want to calculate the total variable cost per unit. So we haven't had to do that in the other questions. So I want to point out again, this is how you figure out what the variable cost is. Direct materials and direct labor are variable costs. Those are considered the prime costs, and almost always they are variable. And then variable overhead is, of course, variable as well. So $12 plus $8 plus $10 is $30. Since the company wants a 40% profit margin based on the sales price, that means 60% of the sales price must cover the cost. This type of margin is calculated as a percentage of the sales price, not the cost. So to find the sales price, we have to take the $30 of variable costs that we do know and divide it by 60%. And that will give us the amount of money that we would have to sell for to be able to get a 40% profit margin. So $30 divided by 60% is $50. So if they had a selling price of $50, then that would mean that 60% would cover the $30 of variable costs. And then the remaining 40% would again be there for working towards profit. The fixed costs are included in the overall profit goal. And since Merit plans to sell 5,000 units, total profit will be $20 multiplied by 5,000. That's $100,000. After covering the $60,000 in fixed costs, Merit will have a projected net profit of $40,000, consistent with the desired 40% margin on sales. So that wasn't the thing that we were supposed to figure out. All we had to figure out here was what's the selling price that they should have, and that's $50. But again, that's not where it really ends. You have to take those $50, multiply it by the units that you're planning on selling, and seeing how much profit you're going to get from that. And that will help you to know how much of the fixed costs are going to be covered. And then after the fixed costs are paid, what the net profit is going to be. And again, you have to subtract the fixed costs from the total profit to get the net profit. So in that question, we learned how to figure out what the sales price is based on just the variable costs and the percentage profit that they want. With that, let's go to the next question. All right, here we are at question 5. Based on this, which of the following is correct? Let's go up to the top. A financial analyst creates a regression model to predict sales based on advertising spending. The model produces a correlation coefficient, or R, of 0.8. So what does this mean? What does a correlation coefficient of 0.8 mean? If you have no idea, which if I'm honest, I had no idea what this was when I was learning this, when I was going through the CPA exam, so I definitely had to learn it. So if you know what this is, that's great. But if not, that's okay. We are going to dive into the explanation right now. All right, here we are at the answer B. 64% of the change in sales is explained by advertising spending. Okay, so let's go through this. Again, if you have no idea what that means, I'm trying to explain it here so that you have a general idea of what this means if you see it on a question. The correlation coefficient, which is R, measures the strength and direction of a linear relationship between two variables. So how strongly those two variables are connected and how linear their connection is. However, it is the coefficient of determination, which is R squared, that tells you the proportion of the variation in the dependent variable that is explained by the independent variable. So just to make sure that that's something that you can understand, an independent variable is one that is not affected by the dependent variable. Think of y and x. X is not going to be affected by y. And again, you're thinking of like the x equals a plus b times x. X is not going to be affected by y, but y is going to be affected by x. And again, x is the independent variable, y is the dependent variable. So when you see something like this, that means that 64% of y is explained by the change in x. Or, for example, 64% of the total cost is explained by the volume of sales, which is X, again, can be explained by the volume, which would be X in this situation. So again, 64% of the variation in sales can be explained by the variation in advertising spending. So again, to kind of bring it back to this question, that means that 64% of the variation in sales can be explained by the variation in advertising spending. The remaining 36% is due to other factors or randomness not captured by the model. It's important to note that correlation does not imply causation, and hopefully you've heard that in your life. This is true for everything in life. A strong correlation or a high R squared suggests a predictive relationship, not a direct cause and effect relationship. So I just want to make sure that's clear. Correlation does not imply causation. So that's a fallacy that we see commonly throughout today's world. But anyway, again, what I'm trying to teach here is the 64%, R squared, which is 0.8 equals 0.64, and that's 64%. That again means that sales, which is Y, 64% of the sales can be explained by the variation in advertising spending, which is X in this situation. Now, I hope that makes a little bit of sense. This is definitely something that if you don't understand it super well, you'll want to go look it up or maybe review it a little bit more in your review course. But I was trying to explain the basics behind it in this question. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions, you will learn or notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about maybe something like this, the correlation coefficient and the coefficient of determination. Maybe not, but again, these are the things that you notice popping up throughout the questions over and over again, or again, maybe something about break-even analysis. And so you take a moment and you write those out in your own words as the pillar topics. And as you're doing this each day, you are building your own personal repository of the most important things you need to know for the exam based on what you learned from the questions. So with that, let's go ahead and dive into the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, let's talk about break-even analysis. Break-even analysis helps determine the sales volume or revenue needed to cover all fixed and variable costs. It can be expressed in units or sales dollars and is calculated using contribution margin or contribution margin ratio. Contribution margin equals sales minus all variable costs and is a key tool for forecasting profitability. It is used in variable costing to assess how much revenue is available to cover fixed costs and generate profit. To meet a profit goal, managers can calculate the units or sales price required based on fixed costs, variable costs, and the desired profit. Profit goals may be expressed in dollars, as a percentage of cost, or as a margin on sales price. Projected profit or loss is estimated by comparing total contribution margin to fixed costs at a given sales level. This allows management to forecast operating income and assess how changes in sales volume affect results. And then finally, this is the last thing we talked about, the correlation coefficient, which is R, shows the strength and direction of a relationship, while the coefficient of determination, which is R squared, shows how much variation is explained by the model. R squared helps evaluate the predictive power of a forecasting model, but does not indicate causation. It just means how predictive it could be. Now, with that, again, those are the pillar topics, the basic ideas of the things that we went through in the 5 questions in this video. Now, remember, that is the end of the YouTube version of this video. We are only doing 5 questions, but Superfast CPA Pro members are going to get access to the full 10-question version of the video so that they can get a little bit more help and a little bit more understanding. So if you like this and you like our other videos, make sure to check out becoming a Superfast CPA Pro member to get access to the full videos. And the easiest way to do that is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to be given a better path and a better understanding of how to become a Superfast CPA Pro member. So check out the webinar, check out becoming a pro member. Now, before you go, if you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.